So this would have been a different presentation on Friday than today, but the slides went up on Friday, so we'll just add to it. In some ways, after the Luna crash, we were fairly optimistic, and other people have commented on this. The Andreessen Horowitz report's a good one, which is, crypto does operate in cycles, and it's operated in cycles from the very, very beginning. And what we tend to see is a run-up in price, a lot of immature projects coming in, a crash, and then a recycling of capital, particularly in the form of talent, producing new projects that move things further forward. So you can see these in terms of what happened even early days in Bitcoin in 2017 with ETH, or in the last year with NFTs through COVID and DeFi summer. And what's important here is developers tend to stay. The trend towards building on Web3 seems to be a perpetual one. And developers tend to be less, although obviously get rewarded based on price, tend to be more committed to the underlying technology and solving problems than some of the speculators and investors are. And so we've seen a cycle of innovation through price troughs. Probably one of the key enablers for the most recent run in DeFi and NFTs has been the layer 2s, right? And so the hopeful version of this story is one in which you believe that what's happened now is simply a repeat of what's happened in the past, and the innovation will continue. Next. Look, the current crash actually started to become visible in December. So, and in fact, you started to see BSC in particular, and a number of what could be described by skeptics as Ponzi schemes on BSC collapsing starting in late December and through January, right? So this wasn't something that just all of a sudden happened with Luna and Terra. There was price erosion before this, and particularly on the Binance Smart Chain, user erosion well before the Luna and Terra situation. The Terra crash is a catalyst, right, that had knock-on effects, but it was visible, starting in late December that something was happening and it wasn't going well. I think most people here are probably aware of what happened. The quick lesson here is, you had two coins that were algorithmically linked, the UST, which was worth $1, and the Luna coin, which backed it up with reserves of Bitcoin and Luna. And the problem was a dollar, you could always exchange one Luna for $1 Terra, so if they depegged, you would get this running, right? Now, what happened on top of this was a crypto crash, possibly intentionally, at the same time as you were getting withdrawals, which meant that the peg became larger and it became just a death spiral to the bottom, right? So you had to overprint more and more Luna in order to satisfy the redemptions, because you could always get $1 of Luna for 1 Terra, so that you had to keep minting the Luna, so the Luna kept depreciating in value and eventually depreciated all the way to 0. But what are the lessons from this? Probably the biggest one is the third one, is if you look at the institutional investors that bought into Luna and Celsius and some of these other networks, that even the smart money got it wrong. And the people who really called this right are the shorts, are the people that were genuinely skeptical of whether this could work in the first place and got on the right side of the trade, right? And so, and the problem with this, of course, is, if the institutional money starts to get burnt and pull back, then that has deep implications for the sustainability of pricing in the ecosystem, right? I don't have a slide on Celsius, but the issue that Celsius is having a different phenomenon, which is really where they don't have enough deposits to satisfy withdrawals, right? This is a classic bank run. People are worried that the bank is going to collapse, so they go and try and take their money out of the bank, so the bank doesn't have enough money to give them, right? And so what Celsius is trying to do right now is get rid of as many of their liquid assets as possible, like their staked ETH, in order to be able to affect the withdrawals that are happening from depositors. Now, what's the lesson here? And in both cases is 20% APY. If you see that, ask why, right? I mean, it's a little bit naive to believe that you can get a 20% yield, especially in an asset as volatile as crypto. So we're seeing something similar. The issue that we have right now is the impact of these two in a row is you had ETH at around 3,000, pulling back to around 2K after Lunaterra, and now down to about 1,000 right now, right? And so, that is disconcerting, and the implication of that is for many projects that have effectively been funded on the crypto cycle, what's their runway now? And the other aspect that we have that's a little different this time is what's going to happen in the broader macro economy, right? If there's a trade-off of risk assets and consumers have less purchasing power, where does crypto and NFTs and the metaverse sit in their priority order when we're seeing all-time high inflation, rents going up, food prices going up, and the job market deteriorating, right? So in some ways, this was a well-deserved crash, right? We had a lot of Me Too projects. We had people piling into the money capture game as opposed to building out stronger and stronger infrastructure. We had projects with no fundamental value capturing lots of value, and and we had this sort of reward for the Ponzi legends, right? And so in some ways, these crashes are healthy in that it pushes out some of the bad behavior in the space. Even though it can create challenges for those of us who work here. And then obviously on top of all that, we had the external factors. So, this slide might be a little bit difficult to read. So why is there hope? Why is there hope at this point in time? Well, there is still positive momentum in the space. And from our perspective, probably the biggest one is the upcoming ETH2 merge, which is going to increase scalability and efficiency of the networks dramatically and integrate L2s more deeply into Ethereum. The maturity of underlying core technologies where there's real R&D and innovation around zero-knowledge infrastructure and the roll-up infrastructure, et cetera, which really probably is the future of scalability, at least as the best we can see it. And third is the adoption of real-world use cases, right? We're at a stage in the cycle where gaming, NFTs, et cetera, have applications outside of the crypto ecosystem into large existing markets. The future rails of the metaverse are presumably going to be crypto, not more traditional financial networks. And the mega trend of us having our lives being increasingly digital is one that's been here for 10 years, not for 2, or 20 years, even not for 2. And so, we remain optimistic that this will be a cycle that sees another ramp of innovation. And our thesis going into this was the cycles are compressing and getting higher highs and higher lows. The challenge we see coming out of this weekend is what is the level of contagion that is going to continue to roll through the ecosystem? Is Celsius it, or is there a next right? ETH at 1,000 is sustainable. ETH at 70 is not, right? And so if we continue to, if we're able to continue at the current level and continue to see the projects emerge and continue, like what you're seeing with the Starkware network that's going live, what you're seeing with the other ZK networks that are going live, then maybe we're in a good place where we can come out of this relatively quickly. But if we continue to see cascading project collapses where we end up with cycling asset prices leading to withdrawals that leads to insufficient deposits in these protocols, networks, and services, then it could be painful for longer than we anticipate. But I'd like to think personally that actually, I've been in this ecosystem since 2016, and the rate of innovation isn't slowing down, and the rate of real-world adoption isn't slowing down either. In fact, when we look at our products, while we are not actually seeing a big drop off in usage. We do see drop off in I mean, obviously, trading volumes tend to be correlated with upswings. So, volumes are going to be down, but users on the systems and developers on the systems actually remain relatively optimistic. So, it's an interesting time in our space where we know that we're in a space that operates on cycles. We know that after each crash, poor projects get pushed out, talent gets recycled, and we tend to see a cycle of innovation. But we're doing this against a backdrop of macroeconomic uncertainty and a level of volatility in the ecosystem that we haven't seen in several years. So I don't have a clear view on where this leaves us. These slides were written on last week instead of on Monday, and I think if we were sitting here last Thursday where it seemed like we were in a more stable environment, the message would be one of greater optimism. I think today, that what we're going to see is a greater amplitude in the ecosystem because more of the projects that weren't fundamentally sustainable are going to get wiped out faster, right? Because so many of these projects are actually funded in ETH underneath at ETH 1,000 versus 2,000 versus 3,000. Their runway and ability to pay their employees is much lower. And so what we're also then seeing, and we're seeing this start with the biggest players out there, right? With Coinbase and Gemini and all the larger, more institutional players announcing 10 to 20% layoffs, right? That may not, in the long term, that may not be a bad thing because it means talented people in the space will become re-injected. But it does seem like we're in for a bit of a painful summer. Okay, I think that's it. Thank you.